So this video will walk you through all three steps of this bond problem. We're going to issue the bonds for cash at their face value. I'll show you that journal entry. I'll show you what happens when we pay the first interest payment on the bonds, and then what happens at the end of the year when we have to accrue for interest that we have not yet to pay to the lender. So I've got this little picture here because I think it's important to always kind of take a step back and say, well, what's really going on with this transaction? And a bond is like a loan. And so on one side of the transaction you have a lender, and on the other side of the transaction you have a borrower, right? So this is the creditor, right? This is the borrower. We call them the debtor. And so this is the person that we're going to account for the transaction for. This is a corporation in this instance, and they need money. They need money to raise to whatever, expand their operations. So they're going to find a worthy lender, or in this case with bonds, it's probably many lenders that are going to extend them credit. They're going to give them money, so the borrower gets the money, and in exchange they're giving a promise, and that's through all the formalities of the bond that we learned. So the details of this problem state that it's a $24 million bond. It's a 20-year bond, and it's a 10% bond, and that percentage right here indicates the size of the interest payments that are due periodically over the life of the bond. They're issued on April 1st of the current year, and they have to pay interest twice a year, semi-annually. So that's an important fact because this 10% is an annual interest rate. So when we calculate how much we owe in interest every 6 months, we know we have to increment it for a 6-month period and not based on an annual percentage. Okay, so we're told the bonds are issued at their face value, and that's very, very, very important because what that tells us is the market rate for the bond, or the yield rate we call that, is equal to the stated rate, or the coupon rate right here. Okay, so they're issued at face value, and so on April 1st we enter into this transaction, and remember we're the borrower. We receive a pile of cash and we extend our promise back to the borrower, to the lender, the creditor, that will repay them. So on April 1st, we have a pile of cash. We're going to debit cash, and the amount of cash we get is 24 million. 24 million. And in exchange for that, we give our promise, which is a long-term liability in this case because we pay it back more than 1 year from the date it's issued. So we're going to repay that entire $24 million. So that's the entry you make at the point in time in which the bond is issued. And I've got this little timeline down here for us because I think that this is very, very, very important. It helps illustrate what's going on now once we've entered into or issued the bond right here on April 1st. Okay, so we've issued it, 3 months into the year. And now we have to account for all the obligations that go along with that contract. And what the contract says is, and you can see in these first 1, 2, 3, 4, 5, 6 months or boxes here, orange boxes, we are going to owe interest at October 1st. And that's interest, remember, is money rent. And so that's for these first 6 months of the bond being outstanding. So we're going to write a check, us being the borrower, on October 1st, that's this date, for the amount we owe. So we're going to have to pay in cash. Our cash is going to go down, and we're going to record interest expense. Now to calculate the amount, you take the face value of the bond, which is 24 million. You multiply that by the stated rate, or the coupon rate, which is 10%. And if you left it right here, this would be incorrect because this is an annual interest rate, and we're paying interest only for the first 6 months. So this is too high by 6 months, or by it's doubled too high. So the calculation should look like this: the face value of the bond times 0.05. So $1,200,000, and that's the entry we would make on October 1st. And the implications of that entry is that my balance sheet, the assets go down, right? Cash goes down with a credit, and this is an expense account. So on my income statement, my net income would decrease because my expenses increase for the interest. Okay, that's pretty straightforward. But now we've got a challenge here. And that is that these last 3 months, all the way through December, we don't pay any interest at that point. The bond says we'll pay interest April 1st and October 1st. So we're not going to make our next interest payment until April 1st of the following year. And so these 12 months here are supposed to represent the time period that are reflected in the financial statements. The balance sheet would be prepared as of December 31st. The income statement would cover all 12 months. The statement of cash flows covers all 12 months. And so if we don't record that interest payment, which we're not going to because that interest payment doesn't happen until April of the following year, we're missing 3 months of money rent, of interest expense. And that is misleading and incorrect if we leave that 3 months of rent, money rent, out of this year's financial statements. So even though we don't pay this interest expense, we have to accrue, we call it accruing for it. So we expense it even though it's not paid yet. And so we're going to expense 3 months worth of interest. So on December 31st, interest expense should increase, but my cash doesn't decrease like it did on October 1st. Instead, I increase this promise, this liability, interest payable. Okay, so the amount of interest, let me show you how I would calculate this. I'd take the face value of the bond. I'd get the amount of interest we owe um, on an annual state, which on an annual period, which is 10% of the face value. So that's 2.4 million. I could break that down into 12 months, right? Divide it by 12. So we owe, looks like $200,000 every month. Well, this is a 3-month period that we owe the interest for. So I'm simply going to take that and multiply it by 3. Oops. I have a circular reference. So I would just take, I know it's 600,000. $600,000. That's how much interest I need to record. So then my interest expense goes up. My net income is no longer overstated because I'm correctly accounting for the all 9 months of interest that we have for that year, and the interest payable increases by $600,000. Now, if I didn't make this entry, my liabilities would have been understated because I increased my liabilities right here, and my interest expense would have been understated. I increased interest expense right here, and of course we don't want to understate a liability. That would be bad, right? It makes us look more favorable to an investor or creditor. And interest expense, if we didn't record that, my profit would have been too high. I'm decreasing profit by 600 grand. Our goal is to get the accounts correct. And so that's how you would account for all 3 entries of this bond when it's issued at face value.